You've spent the last few years reshaping this company, the new AIG, if you will, sold off businesses, divested, eliminated divisions. In your mind, Bob, is AIG right-sized now to move forward?
I think AIG is at a size it needs to be right now, based upon what we had to accomplish. Remember, we had to pay back the Federal Reserve the money they had given us. We had to position ourselves for getting ready to, again, be a strong, public, independent company, which we've done. And so we've sold off some of the businesses of AIG. And so we're at the right size for what we needed to do. But I think AIG is now positioned, as you know, as a new independent company. We've accomplished that with the re-IPO. And so now we're ready to start growing again. And so as we continue to progress, you'll see us grow as a company. So we think we'll be bigger over time.
Treasury still owns 77% of this company. The question on everyone's mind is, when does the U.S. government completely exit AIG? What I'm hearing is 2012, and you'll stay through that period until Treasury has sold all their shares. What's your best estimate of when you think this truly will be a standalone company?
Well, first of all, we are a standalone company. Make no mistake about it, we are the new AIG. AIG has emerged from this crisis as strong, independent, standalone ratings that are investment grade, so we're there. Our goal now is to make sure we help the Treasury sell off their shares such that the American taxpayer from day one, as we've already done, is going to receive back all of their money for their top program plus a profit. So this does not include the $5 to $10 billion that the Federal Reserve could make on their intervention. That's one part of it. Just the TARP piece alone, we expect the U.S. Treasury will sell all of their shares at what they gave us plus a profit. So
in the next year?
I would think if we perform well, we could probably be done in a year.
Is there any question in your mind that taxpayers won't get paid back in full plus a profit? Because this was a company that by most measures was left for dead.
As you saw in this go-around just now, we sold at 29. That was very important because their cost basis was 28.73. So in the first tranche, right out of the box, they've been paid plus a profit for what it is they gave AIG, and that will continue as we progress over the next year. And the better we do, the more shares can be sold by the U.S. Treasury, and the faster they can be paid off. But I can assure you we are working hard in this company to make sure it's with a profit.
You talk about growing this company, so I'm interested in acquisition targets. And if it's hard for you at a point in time when Treasury still owns 77% of this company to go out and spend money and acquire companies that you think are part of AIG's core business and compete with the very competitive environment that we're in. When you say grow, will we see these acquisitions made before Treasury exits, do you think?
We could. We are going to have a capital management program. And clearly, and we've talked about this during the roadshow, we expect to have as much as $25 billion over the next 4 years of excess cash that we'll be able to buy back shares, potentially, or make strategic investments that make sense for the company going forward. We want to put that money into this company such that we are constantly growing, building the platform. So we think targets will come up, like Fuji Life. We've already done that. So we did Fuji Life because it's a business we already had an investment in, and it made sense for us. We'll look for other opportunities, and it could be while Treasury still owns the shares. What's important is that it adds value to the company. If it does, the stock will go up. It's better for Treasury.
One of the things I think is interesting in the terms of the bailout is that AIG is precluded from suing a lot of the big banks that issued these mortgage-backed securities that AIG therefore insured. So you've kind of come out swinging. You've sued ICP more, but you can't go after some of these big banks. What does that mean to you? You sort of smile. What does that mean to you in terms of this recovery and trying to recoup money for AIG?
We're looking at all of our options. There are certain things we had to agree to as part of Maiden Lane 3, which was with the Federal Reserve. There are other things we didn't agree to. And so therefore, wherever we have a legal opportunity, we're going to exercise that legal opportunity to get money back for AIG on the basis of what happened. So that's about all I can say there.
You've said previously there's no more crisis, and you've said AIG has de-risked its balance sheet. When you look at AIG FP and that portfolio, most of which it looks like has been wound down, what's the outstanding risk still? When you have outside people looking at this company and saying, is AIG a risky company at this point?
Well, first of all, the risk is within all of our tolerances. We have a liquidity plan. We show that liquidity plan stressed. We review that with the rating agencies, for example. And we've reviewed that before we were allowed to exit with the Federal Reserve and the U.S. Treasury. So we, as a condition of closing, for the Federal Reserve to let us go, they wanted to make sure that we left in a very strong condition, that nothing would go wrong, especially around FP, after we went out in January. So this is going back to January. So they wanted to make sure we de-risked it. So I can tell you with all of our liquidity, all of our tolerances, that portfolio was acceptable to the banks who were giving us a bank facility, to the rating agencies, as well as the Federal Reserve and the U.S. Treasury. So it's now, it's not the $2.2 trillion we had a couple of years ago.